Hello and a warm welcome. You've joined us on All About Your Company right here on ET Now. I'm Ashesha Advaryu, and on the show today we are going to put the spotlight on GE Shipping, or Great Eastern Company Limited. Remember, was incorporated in the 1940s. It's a 75-year-old company. We'll discuss the outlook, management commentary, everything and more coming up for you in just a bit. But first up, let's talk about the key talking points and the key questions we want answers to from the management. First is the impact of global trade disruptions and geopolitical landscape, which has led to surge in freight costs globally. In fact, if we look at the trend over the last 5 years, freight costs have risen exponentially. What impact is that having on companies' operations? We'll discuss all that and more. Remember, Russia-Ukraine ceasefire talks are in place. What kind of impact will that have on companies' earnings? That is the second most important question we'll try to get answer to from the management. Let's also talk about demand visibility. Company has added one more ship to its fleet. Does this mean company expects demand to revive going forward? That is one question that we'll try and get answers to from the management. The company is also focusing more on modernization than expansion. The company, remember, has bought a second-hand fleet. Why is that? We'll also talk about that. And apart from that, global demand and supply dynamics and India's focus on shipbuilding industry. Is that meaningful? Is that helping the company? We'll discuss all that and more in just a bit, but let's get started. And first, let's talk about the company itself. Remember, GE Shipping is India's largest shipping and oil field services provider. It has a market cap of about $2 billion, which translates to about 15,700 crore rupees. And it is into two separate segments. One is shipping and one is offshore. Now, remember, it generates 75% revenue from shipping and the balance 25% from offshore. We'll also discuss that and more in greater detail. Now, as far as the shipping business is concerned, it is into transportation of crude oil, petroleum products, gas and dry bulk commodities. These are the segments that it mainly caters to. As far as the offshore business is concerned, it offers products and it carries out exploration and production facilities to oil companies. So these are the main two segments that the company operates in. Now, as far as the fleet size is concerned, it has about 17 product carriers, about 6 crude carriers and 14 dry bulk carriers. This is for the shipping segment. And for the other offshore segment, it has several other vessels as well in its fleet. As far as the clientele is concerned, that too is very strong. It has industry leaders, international oil companies and governments within its clientele basket. So that's about the company. Let's also shift focus to some important metric then. And as I mentioned, it generates 75% revenue from shipping business. That's the major chunk of their total revenue pie. And the balance 25% comes from the offshore business. We'll discuss this in greater detail during the course of the show. Now, the most important factor which determines earnings for the company is the freight rates, which is determined by Baltic Dry Index. That, remember, has surged 110% over the last 1 year. Freight costs have risen, and that directly impacts companies' financials and companies' profitability. Now, 4 years ago, tanker rates stood at about $12,500 per day, which had now risen to about $30,000 per day. That's the kind of increase that we have seen in freight costs over the last 4 years, and this is directly having an impact on companies' financials as well. Now, shifting focus to other metrics then, and the first and the most important one is the revenue growth that the company has reported. Remember, in FY23, company reported a sharp uptick in revenue at about 5,700 crores versus just 3,500 crores in FY22. And the most important reason for this was Russia-Ukraine war, which broke in that financial year, which led to tight supply in the global market, because of which freight costs rose, and that is the reason freight costs rose up and company reported an uptick in revenue. EBITDA, meanwhile, also saw an increase in the corresponding period because of the same reason, although in FY25, it moderated a little bit on account of lower freight costs as compared to the prior years. But remember, it has reported 20% EBITDA CAGR over the last 3-year period. So that's as far as the EBITDA is concerned. Let's talk about net profit CAGR then. As again I mentioned, FY23 was a very solid year for the company. which is now normalizing. So in FY24, company reported a net profit largely at par with FY23, and it has moderated a little bit in FY25, perhaps is likely to moderate further going forward as well. So that's the net profit metric for you. Now, in the first half of this year, it has reported margins at about 56.1%. But remember, this is again lower as compared to first half of last year. And I'll tell you why. The most important reason is the moderation of freight cost, and also because company sold some of its vessels, because of which company's capacity came down. So these were the two reasons why financials have moderated in the first half of this year versus same time last year. As I was mentioning, Baltic Dry Index, this is the chart on your screens of the last 10 years, and we can see that sharp uptick. That's FY22, and that was the reason financials got a big jump up in FY22, whether it is on revenue front or on EBITDA front or margins front. Dry Index shot up, freight cost shot up because of Russia-Ukraine war, and that is the reason company's business is also cyclical to that extent, because it is directly impacted on account of freight costs in the global market. Shifting focus to margins then, they've remained steady above that 50% mark over the last 4 years. It was below 45% in FY22, but since then, they've remained largely steady. In fact, it is very steady at about 56.1% in the first half of FY26. So margins clearly are not as big a problem for the company. Company has been able to maintain margins about 55%. Now, as far as the balance sheet is concerned, remember borrowings have moderated to about 1,250 crores in the first half of FY26. This, of course, was led by strong earnings growth that the company has reported over the last few years, and the book value now stands at about 15,225 odd crore rupees. Shifting focus to other balance sheet metric that the company focuses on, and cash flow to EBITDA, that remember is very solid at 99% as on FY25 versus about 93-95% that the company had in the last 2 years. Net cash flows have also been very solid. The company in fact has repaid some of its debt, and the cash flow position also looks very solid. Company also has a good cash balance as of now. We'll also discuss with the management what they aim to do with the cash position. But that's as far as the balance sheet metric is concerned. Shifting focus to return ratios then, and return on capital employed is a little negative because it was below 10% before FY22, then it shot up to 21% in FY23 and has again moderated to about 14% in FY25. So this is one metric that investors should be cautious about, and that is return on capital employed, which has been subpar as compared to other industry peers. Now, as far as the shareholding pattern is concerned, promoters have maintained their shareholding at 30% over the last 3 years. DII shareholding has declined a tad bit in the September quarter, but the number of shareholders who hold shares from the public market have increased exponentially over the last 2 years. If you can get that figure on the screen, the number of public shareholders has risen over the last 2 years. So that's the shareholding pattern for you, but promoter shareholding has largely remained steady. Shifting focus to what analysts are making, we don't have much coverage on this counter. There is only Ambit, which has a buy rating on the stock with a target price of 1436 rupees per share, and the stock currently trades at 1100 odd levels. So Ambit clearly is very bullish when it comes to the outlook going forward, and they have a buy rating on this counter. No other analyst covers this stock. Let's also talk about valuations then. It trades at about 8 times 12-month forward. We don't have a direct peer to compare the valuation with, but 8 times 1 year forward is what the price to earnings looks like. As far as the net asset value is concerned, it stands at about 1180. Actually, this is rupees per share, which is at par with where the share is currently trading at about 1100. So that's the net asset value for you on your screens. As I mentioned, valuation is at about 8 times and the net asset value at about 1170 rupees per share, at par with where the stock is currently trading. But one important metric to consider is also the dividend yield, because it is a dividend paying stock. It has always been a dividend play. In FY23, it gave a dividend of about 28.8 rupees per share. This, compared to the average stock price for the full year, translates to a solid 5.5% dividend yield. This came down a little bit to about 4.4% and 2.7% in the subsequent years, and in FY26 so far it has given a dividend of 14.4 rupees, which translates to about 1.5%. Now let's summarize the entire analysis for you. Profit and loss account was very solid. Of course, it was determined by freight rates in the global market, but very solid. Operational metrics are strong. Margins have been very solid, above that 55% mark. Balance sheet position and cash flow also very solid. As I mentioned, cash flow to EBITDA is very strong at that 99% mark. Shareholding pattern, promoters have maintained their shareholding. Analysts, it's a thumbs up coming in from analysts as well. Ambit is the only one that has a buy recommendation on the stock. And the historic dividend yield is something that investors should put the spotlight on. So that's the entire summary for you of how the company is placed at this point in time. But let's now go to Mr. G. Shivakumar, Executive Director at GE Shipping, who is now joining us. Mr. Shivakumar, afternoon, and thank you so much for taking your time out and joining us here on ET Now. And let's first understand the macro setup that the industry is working in. And it is greatly influenced by geopolitical factors, Trump tariffs, and the kind of sanctions that Trump imposes on Venezuela when it comes to oil as well. What kind of landscape is the industry currently working in, and how do you see that evolving going forward?
Good afternoon, Ashisha, and thank you for having me. First of all, before we start on the answers to the question, just one clarification I'd like to put out. The Baltic Dry Index is an indicator of the rates in the dry bulk market, which is about 35% of our fleet. Yes, it has an impact. There is also a Baltic Tanker Index, which is not as widely followed, which indicates what is happening with the tanker markets. And as you mentioned, a lot of the profitability improvement in the last 3 to 4 years has come from the Russia-Ukraine war, which was a tanker story. So now, coming back to what's happening currently, again, the market is situation is very volatile and uncertain. As you mentioned, that there is talk of a ceasefire between Russia and Ukraine. Currently, we don't see that on the ground. Attacks are happening in the Black Sea on ships carrying Russian cargo. So all of these things are happening even while ceasefire talks are on. If there is a ceasefire, it is possible that freight rates could fall for some time, and therefore take down profitability, because our profitability is directly linked to freight rates that the tankers earn. However, it is extremely uncertain. We are also seeing some US action sanctioning ships which are related to Iran trade, and they're also seizing ships which are involved in the Venezuelan oil exports. So all of these things are happening and creating a lot of uncertainty. This is also leading us to conserve our cash. We have, as you said, we have produced a lot of cash flow in the last 4 to 5 years because the markets have been so profitable. We have not been expanding our capacity. We have been merely modernizing our fleet. We have been selling the oldest vessels and buying slightly more modern vessels of the same kind. We will keep the bulk of our expansion, our capacity expansion, for a time when the prices of ships are lower. We are typically, because we have seen so many decades in the business, we know that cycles will keep going up and down. We're not looking to do linear growth year on year. We wait for the opportunities to buy ships, and we buy when we believe that the time and the price are right.
Right, and Mr. Shivakumar, we will talk about the fleet capacity and fleet expansion plans in just a bit. But because we are on the topic of global trade and its impact on your operations, I understand Russia-Ukraine ceasefire perhaps is likely to take some more time. But if at all it were to happen, say in the next 2 to 3 odd months, how much will prices fall by in the global market? And then what impact will that have on your earnings? If you can compare it with, say, FY25 earnings, how much will the earnings fall by on account of that?
So there will be a negative impact. There are so many moving parts in this that it's difficult to quantify. I will just refer you to what prices or what freight rates were before the war started. So we're talking about 4 years ago, end of 2021. The war started in February 22. Rates for tankers typically were around the 10, 12, maybe $15,000 a day on average. In calendar 2025, so far, we have seen product tankers averaging somewhere in the 25,000 between mid-sized and larger product tankers, averaging somewhere in the 23 to $25,000 range. Crude tankers average more than $40,000 a day. So this is what could potentially happen just on a reversal. However, we don't believe that that is very likely to happen because there are so many other factors which affect it as well. And having said that, if the markets drop, that is exactly what we are waiting for. While it will affect profitability, we will be looking to invest when freight markets drop. Ship prices also drop. You mentioned that we paid down a lot of our debt. Not just that, we are sitting on a huge amount of cash as well, and we are waiting to deploy that cash. So we are fine if the market drops, and we will be looking forward to an opportunity to deploy our capital in capacity expansions.
Okay, and Mr. Shivkumar, you also bought a 2015 South Korean built vessel, right? And it was just informed to the exchanges about 2 days back. What kind of thought process did you have when you bought this? Is there improvement in demand visibility over the next few months? Is that the reason why you are adding to your fleet?
We bought these ships typically for replacement of ships that we have sold earlier. So that's the transaction that we are doing. We're also looking at where we have a lot of capital to be deployed, and we are looking at making incremental investments to maintain our market position and to service our customers better. So that was the logic behind this acquisition.
Okay, and you're also sitting with a lot of cash. You've repaid quite a handful amount of debt. If you can take us through what's the roadmap now. I understand that you will be deploying cash to buy more vessels as and when the opportunity is right. Whenever freight prices come down, you are looking to add more vessels to your fleet. But then if you can take us through the entire roadmap, how much will be used to repay your debt, how much will be for your fleet expansion plans, and in that context, what is the visibility on demand looking like, especially since we are talking about the fact that Russia-Ukraine war and peace deal is not likely to be signed anytime soon. What kind of visibility then do you see for demand going forward?
Um, if markets stay like this, so we should continue to earn these rates. In this, I should point out that the crude tanker rates have really strengthened in a big way in the last 3 months. Ships which were earning $35,000 a day approximately in September, which is the larger crude tankers like the Suez Maxes, are currently earning $60,000 a day, maybe $50,000 to $60,000 a day. So profitability and freight rates have gone up quite a lot already. So that's where rates are currently. We don't know what can happen to those rates going forward. The spot market is extremely volatile. Pricing changes by $20,000 a day for spot voyages between a Monday and a Friday of the same week. Uh, and because our fleet is 80% spot, exposed to the spot market, it becomes very difficult to call what kind of earnings we could have. So this market is very volatile. All that we look at is if the market goes down, are we in a position to ride out that part of the cycle? And if it goes down, not just ride out the cycle, but there will be opportunities for investment. And will we be able to take advantage of those opportunities? If the market goes up because we have such a significant spot exposure, we will enjoy that profitability, which then we will keep in reserve for investments at the right prices.
Clearly, and we understand that it is very difficult to predict the macro environment that we are living in and the impact it will have on companies' operations. But Mr. Shivkumar, let's also talk about margins because they have been very steady about that 50-55% mark. If you can take us through what factors determine margins and any kind of volatility that you're expecting on margin front going forward?
So I would not pay too much attention to give too much importance to this margin because most of the costs, our operating expenses, our overheads are more or less fixed. They don't vary depending on what rate whether the ship is earning $15,000 a day or $50,000 a day. The cost base of the ship is fixed, including on fuel as well. Of course, fuel prices do vary. So our business, and I assume you're talking about EBITDA margins, we don't track it that much. Our business is a very capital intensive business. Typically, 50% of the costs will be below the EBITDA level. So, interest and depreciation are significant costs for us in normal times. Currently, they are not that high because our fleet is much lower as compared to, so our interest is negative currently. So the margins typically should be for such a capital intensive industry should be around the 50% mark. If you're not around the 50% mark on after removing the fuel expenses, then you would probably not be breaking even. But if you take into account fuel expenses and you know that FY22 we made only a 43% margin, if you take even fuel expenses into account, you probably will break even around the 35 to 40% EBITDA margin levels. But again, the fuel expenses are typically a pass through. If fuel prices are high, that comes into the freight rates as well, usually.
Understood. So it's a capital intensive business and hence most of the expenses come below the EBITDA margin level, and that is the reason margins look healthy at that 55% mark. But Mr. Shivkumar, government has also been investing or rather allocating a lot of money for this sector. It also recently came up with a 70,000 crore maritime development fund. Is that having any kind of positive impact on the industry and for you in particular?
So far, what we've seen of the maritime fund and there are 3 or 4 initiatives there. Most of those are towards the shipbuilding industry. So there are a lot of incentive schemes for the shipbuilding industry, including capital contribution and interest subsidy schemes proposed. There is not much for ship owning really. So far we are not able to see it making a big difference to our to our profitability or any such thing. We do appreciate that the government is trying to give a push to the maritime ecosystem for a country which has so much of foreign trade and such a big coastline. It is very important to have a maritime ecosystem, and we appreciate that. But for now, there is not much impact on the ship owning space, really.
Okay, and Mr. Shivkumar, since we are talking about your fleet expansion, what is the strategy that the company is working with? Is the company focusing more on modernization and replacement rather than expansion? Is that a conscious effort that the company is taking?
Yes, that is absolutely correct. For now, we are only focusing on modernization so that we don't lose capacity. We will do the capacity expansion when we get, as I said, when we get the right prices. This is how we have gone through several decades in a very difficult industry. And we believe that is what will enable us to make superior returns. And therefore, we will wait for the right prices to do our significant expansion of capacity.
Clearly, it's a very difficult industry and business to operate. Mr. Shivkumar, thank you so much for taking your time out and joining us here on this special edition right here on ET Now. Thanks so much for joining us today.
Thank you.
With that, it's a wrap on this edition of the show. Thanks so much for tuning in. More news and updates will continue on the other side.